Yeah, welcome to the last session of Unit 4. Today, we are looking at taxation of companies. By the end of the section, you should be able to describe the incentives available to certain companies, determine the chargeable income of a company, and compute the tax liability of a company. Before we solve an example, let us look at some industry concessions. A company is an artificial person, which is considered an economic entity separate from its owners. It has tax-bearing capacity separate from its owners or shareholders as well. This means that a company is liable to tax separately from its owners. Remember, we have already talked about the principles for deductions allowed and deductions not allowed. We are going to use the same principle in assessing companies for tax. Industry concessions. Remember, we defined this in Unit 1, Section 6 as the period where preferential tax treatment is given to certain firms or entities where they either pay low or no tax, and this serves as an incentive to them. Let us look at some of these companies and the type of concessions enjoyed by them. So for an agro-processing business, it is exempt from tax for a period of 3 years of assessment. 3 years of assessment. However, the income of a company from agro-processing business established in Ghana or after the financial year commencing 1st January is exempt from tax for a period of 5 years. The income of a company which produces on commercial basis cocoa byproduct derived from standard, substandard cocoa beans, cocoa husk, and other cocoa waste as its main raw materials is exempt from tax for a period of 5 years of assessment. So where a company conducts both farming and agro-processing, the company may elect to be treated as if the business were a farming business or a processing business and claim the exemptions for which it is eligible. The income of a company whose principal activity is the processing of waste, including recycling of plastic and polythene material from agricultural or commercial purposes, is exempt from tax for a period of 7 years of assessment, commencing from when it started operation. The income of a rural bank from a business of banking is exempt from tax for a period of 10 years of assessment. Rent income of a person from any residential or commercial premises is exempt from tax for a period of 5 years. Then for construction, for sale or letting of residential premises, it is exempt from tax for a period of 5 years of assessment. We also have the income from cocoa of a cocoa farmer is exempt from tax. Please, here they are saying that the income from cocoa of a cocoa farmer is exempt from tax. It means the income of a cocoa farmer is not exempt from tax. It is subject to tax. But the income the cocoa farmer gains from producing or selling cocoa is exempt from tax. Please take note. The income of the Ghana Stock Exchange is exempt from tax for a period of 31 years of assessment. Privately owned universities are exempt from tax when they plow back 100% of their profit after tax into the business. Farming business in Ghana is also exempt from tax. So in the case of tree crops, it is exempt from tax for a period of 10 years. In the case of farming livestock, fish, cash crop is for a period of 5 years. And in the case of cattle, it is for a period of 10 years. Let us look at the tax rate applicable to companies in agro-processing after the tax holidays. For those located in Accra and Tema, their company rate is 15%. Those At the other regional capitals outside the three northern regions, the rate is 12.5%. Those outside other regional capitals, 10%. And then for the three northern regions, we have 5%. The general corporate tax rate in Ghana is 25%. For companies engaged in non-traditional exports, it is 8%. When we say non-traditional exports, we are talking about horticultural products, processed and raw agricultural products grown in Ghana, other than cocoa beans. We also have handicrafts, locally manufactured goods, etc. Rural and community banks, the rate is 8%. Companies listed on the Ghana Stock Exchange, 22%. Companies engaged in hotel or hospitality industry, 22%. For income of financial institution from a loan to a farming enterprise for use by that enterprise in the production of its income, the corporate tax rate is 20%. For income of financial institution from a loan to a farming enterprise for use by that general enterprise in the production of its income, the corporate rate is 20%. For those in the petroleum and mining operation, it is 35%. Income from rent of commercial property, the corporate tax rate is 15%. Income from rent of residential property, the corporate tax rate is 8%. Income of a trust, the rate is 25%. Free zone company after the concession period. In the case of export of goods, it's 15%. And in the case of domestic sales, it is 25%. Let us note that free zones are exempt from tax for the first 10 years of operation. The income tax rate applicable to companies chargeable The income tax rate applicable to companies chargeable income from a manufacturing business other than manufacturing business located in. When we come to manufacturing businesses, we have some locational incentive. So those located in Accra and Tema pay the 25% of their income as tax. But those located in regional capital of company, out of the 25% you pay as tax, 75% is paid instead of the full 25%. So 25% of the 25% is given as locational incentive. So you end up paying only 75% of the income tax applicable. If you are a manufacturing business located elsewhere in Ghana, 50% of the corporate tax rate, which is 25%, is given to you as locational incentive. So you end up paying only 50% of the 25% as tax. So here, for the 75%, you can apply a straightforward rate of 18.75%, and for the 50%, you can apply a straight rate of 12.5%. So it means that you have to know the various regions and their capitals. So for example, if we have a manufacturing firm located in Takrady, that person or that company will pay 18.5% of the chargeable income as tax. If it is located elsewhere outside the regional capital, let's say Anaji, it will pay 12.5% of the income as tax. Let us take an example. But before that, let us look at employment of fresh graduates. A fresh graduate is a person who has graduated from a tertiary institution for the first time, whether or not that person was previously employed. In the computation of income of a company, the company is entitled to an additional deductions for salary and wages paid during the year to fresh graduates from a recognized Ghanaian institution. So the additional deduction is as follows. If the percentage of fresh graduates in your workforce is up to 1%, 10% of their salaries and wages is granted as additional deduction. If it is above 1% but not more than 5%, 30% of their salaries and wages is granted as additional deduction. And if it is above 5%, 50% of their salaries and wages are granted as additional deductions. Now let us look at an example. Below is the profit or loss of Osumat Limited, a manufacturing company in Takrade, for the year ended 31st December 2020, submitted to the Commissioner of Domestic Tax Revenue of the Ghana Revenue Authority on 30th April 2021. So we have the income statement, gross operating profit, dividend, less general expenses. We have all these figures. Then we have our net profit of 242,950. The following are notes to the account. Research and development expenditure, acquisition of a new machinery. So what we are going to do is that we will take the notes one after the other and determine which expense is allowed and that which is not allowed. Research and development expenditure. Acquisition of a new machinery, 28,500, and staff training cost, 31,000. We know the acquisition of machinery is disallowed and the training cost is allowed. Advertisement, cost of neon sign, 20,500, media advert, 28,500. Media advert is allowed, cost of neon sign is disallowed. It's of capital nature. Same for the acquisition of machinery. They are all of capital nature, so they are disallowed. Staff welfare. We have refund to staff medical bills, cost of canteen equipment, safety wear acquired for staff. We are going to allow refund to staff medical bills and safety wear acquired for staff, and disallow cost of canteen equipment. This is because it is also of capital nature. Donation and subscription. Donation to Ghana Heart Foundation. Goods given gratis to custom officials, and subscription to Ghana Manufacturers Association. We are going to allow the one in respect of Ghana Heart Foundation and the Ghana Manufacturers Association, and disallow goods given gratis to customs official. This is because we are donating for national purpose, or we are donating for the greater good of the public. So here one trick is that any donation given to Ghana something something, so Ghana Football Club, Ghana Manufacturers Association, Ghana what name, it is allowed. And then those in respect of individuals, let's say church, elders, chief, officials, it is disallowed. So please let's take note. Bad debt, general provision, we are going to disallow, and specific bad debts we are going to allow. We have capital allowances agreed as 65,240. The total workforce is 125. This includes 5 fresh graduates. Compute the tax liability of the company for the 2020 year of assessment. So we'll go back to the question again so you can put down the question. Okay, let's start with the computation. So, Osumat Limited, computation of tax liability for the 2020 year of assessment. So we have our year of assessment and our basis period. We have our CD sign here and our CD sign here. So we start with our reported net profit. we had reported net profits to be 242950. We are going to less dividend. In Ghana, dividend suffers a final withholding tax of 8%. So once you pay that 8% on dividend, it's not supposed to be taxed again. So you do not include it in your incomes to be taxed again. So we have to deduct the dividend. And when we deduct, it's giving us 147950. Now let us look at the expenses disallowed. So we have from the financial statement, we acquired trademark, so acquisition of trademark. We know trademark is a depreciable asset, class 5, and is of capital nature. So we have to disallow this, and the amount is 30,000. Then we had research and development. We had some notes. Okay, the notes told us that acquisition of a new machinery, 28,500, and then staff training cost 31,000. And we said we are going to disallow the acquisition of new machinery, 28,500. Then from our financial statements, we have loans to staff written off. This is automatically not allowed. So we are going to add back. So 53850. Then we have advertisements. For advertisements, we had neon signboard and then media adverts. And we said adverts of capital nature are disallowed and those in the media are allowed. So we are going to disallow an amount of 2,500. Then we have staff welfare. Staff welfare. Under the staff welfare, we had some refunds to staff medical bills, cost of canteen equipment, safety wear acquired for staff. And we said we are going to disallow the one in respect of cost of canteen equipment. And the amount is 3,800. Donations and subscription. Under that, we said we are going to disallow the one in respect of goods given gratis to custom officials. The amount is 13,200. Then bad debt. We have specific and general provision. We are going to disallow the one in respect of general provision. So we have 25,000. Then we have depreciation. Automatically, we disallow depreciation, 81500. So now let us add these things together. 30,000 plus 28,500 plus 53,850, 2,500, 33,800, 13,200. 25,81500. When we add all together, we are going to get 286350. We are going to get an adjusted net profit of 434300. So adjusted net profit. Okay, so now let's deduct capital allowance. We're told that capital allowance is agreed at 65,240, and we had some fresh graduates, so we are going to have an additional deduction. We're told that the fresh graduate is what? 5 out of 125. So let us look at the percentage. 5 over 125 times 100. This is going to give us 4%. And we're told that when it is above 1% but not more than 5%, 30% of their salaries and wages is granted as additional deduction. Okay, and in this question, we're told that the fresh graduate wages and salary was 25,000. So here the additional deduction, we are going to have 30% times 25,000. And this is giving us 7,500. When we add it to the capital allowance, we have a total deduction of 72740, and we are going to get an income of 361560. So this is chargeable income. Now we're told that it's a manufacturing firm, so it's entitled to some locational incentive, and it is located at Takrady. So it means that this company is going to pay only 75% of the 25% as tax. So tax at 25%, we are going to get 90390. So less tax incentive. So we have 25% times 90390, and this is 22597.5. Where we deduct, we are going to get a net tax of 67792.5. So the company is liable to a tax of 67,792. So net tax payable. With the computation of the tax, you can also use the straight method. So when you have your chargeable income of 361,560, you come to tax at 18.75. So you are going to get straight away the net tax payable. So you can either do it using the first method or the second method. So you can either compute your tax this way or this way. Whichever one you do, it is correct. So this brings us to the end of today's session. In this session, we discussed some incentives available to certain companies. We also learned how to compute the chargeable income and tax liability of a company. Hope you enjoyed this session. Thank you.